This is a presentation of Ramsey's Capital. Go to our website at www.ramseyscapital.com. Hi, it's Mark. A while back, I posted a blog, if you will, and a video concerning the due diligence process for buying multifamily properties. And the first post was about the legal due diligence. And as I mentioned in that there are basically three major facets of due diligence. One is the legal, which we've covered. The second is the financial due diligence, which I'm going to cover today, and I've covered in a post already. And the third is the physical due diligence, which I will cover in my next presentation. So this is part 2 of a 3-part series on due diligence. So the first thing you've got to realize is that the asking price is not always the price that you're going to pay. In fact, it almost never is the price you're going to pay. And the price that you pay is based on your negotiation with the seller and the seller's broker. So in order to determine that price, your first step is to take the information you get from the seller or the broker, which is generally in an offering memorandum, and use that to do your own budget and projections into the future. So one of the things you really need, and if you can't get this, you've got to really question whether or not you can move forward with the deal. You need the trailing 12 months of financial statements in order to provide the information that you need to do your budget and projections. You need to know what has happened over the last 12 months. So once you get that from the seller and the broker, you need to put these numbers into your own spreadsheet that you have that is designed to do projections and come up with a potential purchase price for yourself. Now, what you want to do is use these numbers in order to do your projections, and the numbers have to suit what you are doing as a sponsor or a syndicator, what your investors are looking forward to getting from the investment, and based on that information, you can come up with an offer to the seller. So if the numbers don't work for you as a sponsor or your investors that you're dealing with, you can't do the deal. So let's assume for now that the numbers work, you made the offer, you do the negotiating, and now you have an agreement where you can do a purchase and sale agreement, okay? So you take those numbers that the seller and his broker gave you, and now you need to verify the information. So part of what you have asked for will include bank statements, rent roll, information on how they do the applications. You want to verify deposits against what they're saying rent is that came in. You want to look at invoices. And now you can see we're kind of getting a cross between the financial due diligence and what's to come in the physical due diligence. So when you're doing this verification, things you've got to realize is you're looking at net operating income and figuring out what, based on that net operating income and that area cap rate, is what the value of this property is. So why is that important? Well, you're doing it on a cash basis. On a cash basis, you have to be careful that the seller is not manipulating information on you. For example, if I want to increase my net operating income and I know in 6 months I'm going to be selling my property, toward the end, say the last 3 months, I start delaying payment on my bills. So a lot of the expenses that should have been in the trailing 12 don't get in there. The other side of it is rental income. You can make sure that the rent that you are receiving is actually being deposited. You can also look at that and see if the rents are actual rents for that area. So, that gives you some possible wiggle room for value add, where if you can increase the rate, where if you can increase the rents, it will help you increase the value of the property and your numbers will work a lot better. You want to make sure, again, as part of what's going on here, knowing that the seller may have known a long time ago that he was going to sell the property, you want to make sure that in addition to him not accepting people who don't qualify, for example, I use the example of sex offenders that you don't want in your complex because maybe you've got children living there too. You may have a situation where the people don't meet the credit standards that you've established or that the seller has established. They're letting them in anyway. When they do that, they're improving their occupancy rate. They are also improving the cash coming in. Another example that you have to be careful of is concessions. Are they giving concessions to potential renters that normally they wouldn't give concessions on? Like, I'll let you in for 12-month lease and you don't have to pay the last month of the lease. So now it's your problem, not their problem, because they're putting the concession at the back end. So these are things you have to look out for when you're doing your financial due diligence. You want to verify the numbers that they gave you, and I've given you some examples, and this is just a summary of some of the things you've got to go through. If you can get audited statements, that's great. And based on what you find and the documentation you get, you can either feel comfortable in moving forward to the physical due diligence stage, or even at this point you can say, look, I didn't get what I wanted, or what you told me isn't in fact what exists here, and the deal's off. So the next phase that we're going to talk about, and I hope this summary helps you understand the amount of work that goes involved into the financial due diligence stage. So the next piece of what we will do is the actual physical due diligence when you're out at the complex and doing what you need to do. Okay, so thank you guys. Thanks for paying attention, and I will give you that third piece very soon. Have a good day.